Your market news now. Global shares are mixed in a week that's packed with central bank meetings and data on U.S. inflation that could make or break market hopes for a rapid-fire round of rate cuts early next year. Friday's upbeat U.S. payrolls report has already seen investors scale back expectations for a March cut by the Federal Reserve, though May remains priced in at 76%. Locally, the latest consumer price index data from China showed rising deflationary pressures as weak domestic demand cast doubt over the country's economic recovery. Chinese officials pledged to spur domestic demand and consolidate and enhance the economic recovery in 2024. To break down some of the market dynamics, we are joined by Roy Mutsini, who is a portfolio manager at Sanlam Investments. Roy, thank you so much for your time. You look at that jobs report coming out of Friday, and as we head into more central bank meetings, including that key US CPI, how do you explain the cautious optimism, I suppose, that's playing out in the market right now?
Hi, thanks for having me. So I think if you take it into perspective, as we've gone through this year, the belief has been of an imminent recession. But with each data point that's come out of the US, the economy has been stronger for a lot longer than people expected. I think from that jobs report, what was very clear is the US economy is slowing, that's for sure, but not as fast as people expected. The labor market there is also softening, but not as fast, and it hasn't reached the point where people were expecting. So I think there's a clear understanding that with inflation still remaining elevated, there's not yet a need for rate cuts, and that's pretty much where the Fed is. Like you said, the market's repriced itself and is moving rate cuts a little bit further out. But that's where this dynamic keeps on playing, that the economy is stronger than people expect, and each data point keeps on pushing these things further and further out.
I was going to ask you then, what do you make of the overall narrative we've had over the past couple of months in terms of where the Fed is and where the market is expecting the Fed to be?
So remember, the Fed is largely driven by inflationary expectations, and while inflation is coming down and the economy is remaining relatively strong, I think the rest of the market is seeing at some point there's going to be some sort of recessionary pressure. The Fed doesn't want to cut too soon because inflation hasn't reached its target, but the market is pushing them in that direction. I think what you probably have is an expectation of lower interest rates. But remember, if a cut does happen, as we stand right now, it's not going to be because we've had a soft landing. It's probably because a recession becomes absolutely imminent. And in all likelihood, what you get is more cuts than people are pricing in, because then the Fed will figure we're a little bit behind, we're quite behind expectations and quite behind where we should be, so let's cut aggressively. So you add all of this together, then you'll probably find that the market wouldn't actually get disappointed at that point, because they were expecting cuts, and what you're getting is more cuts, but even softer growth. So it's a bit of a confusing conundrum that we're in right now, but I think the bottom line here is that economy remains relatively strong. The likelihood of a soft landing is pretty high, but the risk of a recession still exists over the short term.
Let's look ahead to 2024. What do you make of some of the moves we've seen in asset prices and even the rallies we've seen over the past few weeks? Is that something you're expecting going into 2024? How are you looking at things?
So I think the bigger driver in the most recent weeks was exactly the expectation of a Santa rally and the fact that in all likelihood we're going to get a soft landing. But looking at the trajectory of the data, like I said before, as we move into that year, it's going to get closer and closer and closer to the point where we actually have a tipping point, whether the economy just flattens out and resumes growth, or whether we actually go through that negative point and we get into a recession. That's the major call. But remember, what markets are probably doing is they're looking through all of this. Like I said, they're expecting a certain number of rate cuts. I think the market acknowledges that these rate cuts would come through in the event of heightened expectations of a recession, or actually a realized recession. And in all likelihood, at that point, you probably get even more. So the market looks through this and says, it's not going to be as bad as you can imagine. And in all likelihood, if you position yourself right now, you'd probably be in the right place for the uptick. But I think there's great risks to that. The US is the only one that's growing globally. China is soft, like you mentioned. The Europeans and the UK are also quite soft. And in all likelihood, they might actually have to cut before the US. And if that happens, you have a stronger dollar, and that's not good news for the rest of the market. So it's a bit of a circular reference. And I think the data points that are coming through are very confusing. And that's why you're going to keep seeing this schizophrenic market that is totally data dependent. And each time there's a solid data point, it reacts in one way. A negative data point, it will react the other way.
You look at crude trading at $75.24 a barrel. How are you framing some of the moves we've seen in crude prices?
So the whole narrative around crude was that between OPEC Plus, including both Russia and the Saudis, that they would be able to tweak production to keep prices high. But what's coming through is that I think the market is losing faith in their ability to actually do that, keep prices high but cutting supply. I think there are members of OPEC Plus or the broader OPEC grouping that have to continue producing. And even for both Russia and Saudi, there's a certain level of production that you need to have to keep paying your bills at home.
Yeah.
So the expectation was that the US would be able, that the US replenishing strategic reserve would be sufficient demand, but it's quite clear that they're being very measured as to how they're buying back that oil. So it just seems like what we're looking at right now is softish oil prices going into the beginning of next year, which is actually good news for importers such as us.
Yeah. Roy, let's leave it there. Thank you so much for your time. That is Roy Mutuni, a portfolio manager at Sanlam Investments. Tomorrow, we are expecting US CPI data for November. It is the last data point before the Federal Reserve meets on Wednesday. We're expecting them to leave rates unchanged, but the main attraction is going to be the dot plot and the economic projections, which we last saw in September. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.